This is In the Black, a leadership, strategy and business podcast brought to you by CPA Australia. Welcome to In the Black. In this special Crime by Numbers episode, we're talking about cooking the books. From Wirecard to HIH and Big Un. Do you know the telltale signs of the fraud triangle? Here is Jacqueline Blondell and Crime by Numbers.
Financial statement fraud involves various degrees of cooking the books, or falsifying numbers to misrepresent a company's financial position. Some of the most high-profile cases include US energy giant Enron, UK construction firm Carillion, and Australian insurance giant HIH. One of the most elaborate recent examples is German payments processor Wirecard. The company collapsed into insolvency in June 2020, shortly after revealing that €1.9 billion in cash balances on trust accounts, about a quarter of its balance sheet, did not, in fact, exist. Dan McCrum is an investigative reporter from the Financial Times in London. His interest in corporate misbehaviour helped expose Wirecard. He remembers the pivotal moment he realised Wirecard was a smoke and mirrors organisation.
The one which sticks in my mind is when my colleague Stefania goes to the Philippines and she finds where there's supposed to be an international payment processing company. But it's a fisherman's house where a couple of guys are giving a poodle a haircut. And in that moment, we thought to ourselves, this is it. This is the smoking gun.
The story of Wirecard unfolded like a classic Hollywood blockbuster. The company was founded in Munich in 1999 as an online payment processor. Its clients at the time were mainly pornography and gambling websites. Fast forward 2 decades later, Wirecard was reporting revenues of more than €2 billion. In 2018, the company joined the DAX Blue Chip Market Index with a market capitalisation of more than €24 billion. This made it one of the 30 most valuable German companies listed on the Frankfurt Stock Exchange, up there with Volkswagen, Siemens and Deutsche Bank. At its peak, Wirecard employed more than 5,000 people in 26 countries and was one of the largest digital payment processing companies for major global financial players, including MasterCard and Visa. But something didn't quite add up. Dan McCrum began looking into Wirecard following a tip-off a few years prior to its 2018 debut on the DAX.
The first time I heard the name Wirecard was actually an Australian hedge fund manager, John Hempton. And we were chatting and he knew the sort of thing I was interested in. So he says to me, "Hey Dan, would you be interested in some German gangsters?" Yeah, that sounds really interesting. And when I took a look, he was talking about Wirecard, and it was this funny little company worth about €4 billion. And it did something to do with payments, moving money around from credit cards to businesses. Called itself the European PayPal. But when I read its annual report, it was sort of full of gobbledygook, didn't make sense. And it was really hard to get a grip on how its business actually worked and how it made its money. And then a month or two later, this English hedge fund manager gets in touch as well. Complete coincidence, he's also taken a look at Wirecard. A guy called Leo Perry of Ennismore Capital. And he sits down and lays out in front of me this whole theory about how Wirecard is faking its profits. And it's hiding that fraud by buying up a whole load of businesses all across Asia and doing some funny accounting tricks with them.
These funny accounting tricks are more commonly known as financial misstatement. In fact, the specific type of fraud that brought down Wirecard was round-tripping, which involves sending money on a bit of a journey. Here's how Dan McCrum explains the concept.
You send it out of the company, off to a friend, who looks after it for a while and then sends it back. And you can do this in and out and in and out. And what's happening is the money is going on this journey, but there's no real business happening.
This is a journey that even the most experienced auditors can find hard to follow. Dan McCrum frames the process through this example. Say $2 million is sent to a business in one country, which then pays out an invoice for $2 million to an outside company.
And then that outside company becomes a customer in India, and it buys $2 million of software from Wirecard over in India. And so if you're just looking at each transaction individually, it kind of looks legitimate. But in aggregate, nothing has really happened. They've just created some paperwork and moved money in and out. And that's a really simple fraud. You know, you're creating costs in one place and you're creating sales in another. What Wirecard was doing was finding rubbish businesses in Asia, and it would spend its fake cash on these businesses at fake valuations. And so there you go. You swap money the auditors will look for some assets on the balance sheet. And Wirecard's were stuffed full of intangible assets. What happened was when you looked through the documents on the ground in Asia, you know, sort of local corporate filings in Singapore, press releases to do with the businesses published locally, the numbers there didn't match up with what Wirecard was saying back in Germany. Now, there's this American short seller called Mark Kahoditz who has a phrase I love, which is, there is never just one cockroach in the kitchen. And so what really stood out to me was the company is lying about what it is doing in Asia. And that was sort of the starting point. But the thing is, it wasn't completely clear cut because there were two theories about Wirecard.
One theory was fraud due to misstatement. The other was money laundering.
You have this company which is growing really quickly, genuinely by operating in grey areas and occasionally stepping over the line and processing illegal payments. So for things like online gambling, particularly in the United States after it was made illegal.
What ultimately drew the attention of Wirecard's auditor was a €1.9 billion cash anomaly in the company's 2019 financial statements. The funds couldn't be located in any of Wirecard's trust accounts, and the auditor refused to provide its report on the company's financial results. In June 2020, Wirecard was forced to admit that those €1.9 billion did not exist. Shortly after the admission, Wirecard became the first ever DAX member to file for insolvency, owing close to €3.5 billion to creditors. Accounting fraud is about much more than fudging a few numbers in financial reports. When large corporations such as Wirecard implode, they leave a trail of destruction. Behind the high-profile scandal, there are innocent employees who've lost their jobs, there are investors who've lost money, there's the loss of public trust that ripples throughout the corporate sector, and a shadow can be cast on the accounting profession in general. Geoffrey Luckens, FCPA, a director in audit and assurance services at Melbourne accounting firm William Bark, says, fortunately, Wirecard-style fraud, at least on that scale, simply doesn't happen that often.
My initial observation about financial reporting fraud is that it rarely happens. So that when an Enron or a WorldCom in the US, a Wirecard in Germany, or a Big Un in Australia comes along, it does strike you as a big surprise.
Big Un was a listed video play company that collapsed in 2018 after an investigation into its earnings revealed elaborate and extensive accounting fraud. When large-scale fraud does happen, the logical question is, why? Forensic accountant Glenn Unicombe, CPA, can shed some light on this. He worked as an investigator at Australian corporate regulator ASIC and investigated some of the country's most high-profile corporate collapses, including the $5.3 billion implosion of insurance giant HIH back in March 2001. His experience shows that the motivations behind cooking the books generally fall into two baskets: flat-out personal greed or a desperate attempt to keep up appearances.
I've lived and breathed the history of fraud in Australia. The characteristics of the frauds committed in the late 80s and early 90s was more what I'll call crudely as fingers in the till. So it was basically straight out fraud for personal benefit. Whereas in 2001, when HIH collapsed, the hallmarks of the fraud, or when I say fraud, the misconduct in that particular instance was motivated by the window dressing of HIH's accounts, basically to cover up its deteriorating financial position.
This window dressing aimed to cover up reinsurance arrangements between HIH and global reinsurance group Hannover Re. The deals were accounted for as conventional reinsurance contracts, but were actually financial reinsurance contracts. And by accounting for them incorrectly, HIH could report a far greater operating profit for the 1999 financial year.
At the time when this arrangement was entered into, HIH had been suffering reputationally in the market because there were rumours spreading that HIH was not achieving the results it had in prior years and that its profits were on the decline. In fact, it was deteriorating into a loss situation. So in actual fact, for the 30th of June 1999 accounts, HIH should have declared a loss of approximately $114 million, which obviously would not have been a good look in the market and would significantly impact the share price. So this reinsurance arrangement was put into place so that HIH could record an additional $92.8 million profit based on the timing between the payment of the premium to Hannover Re and the transfer of claims off HIH's books. So in other words, because of the timing of the transfer of the claims, it enabled HIH to record an additional $92.8 million in profits. Instead of recording a loss of $114 million, HIH recorded a loss of $21 million.
To understand why people commit this kind of fraud, Glenn Unicombe draws on a framework commonly used by auditors, the so-called fraud triangle. The first side of the triangle is opportunity.
A fraud will only occur where a person has the opportunity to commit the fraud. So if you've got weak internal controls in your organisation, well, people who want to extract money out of the company will be able to see gaps in those controls and exploit them. Also, under this tag of opportunity is the actual cultural compliance circumstances of the group of companies. If you have a compliance culture which is weak, where people draw to management's attention that there may be gaps in the control framework or that people are not following the protocols, management chooses to ignore that for whatever reason, that will again give momentum for an opportunity to commit fraud.
Corporate culture certainly came into place at Wirecard. Dan McCrum says that when an employee in Wirecard's Singapore office uncovered some dodgy dealings within the company, he was promptly shown the door.
A lawyer launched a whole internal investigation and they found out, yeah, this is what's going on. There's a whole bunch of weird little frauds for sort of $2 million there, $2 million here. Fake contracts, fake invoices. And what happened was the lawyer did the right thing, reported this back to head office in Germany. Guys, there's $2 million about to go out the door and Doesn't seem there's any real reason for it. And what happened was his whole investigation was squashed. Germany says, it's all right, we'll take it from here. And the lawyer is the one who is forced out.
The lawyer's name was Pav Gill, and, according to Dan McCrum, firing him was the beginning of the end for Wirecard.
They allowed him to stay till the end of the week. They didn't walk him out the door there and then. So the next morning, he comes in with a hard drive and takes a copy of the entire internal investigation and all the documents. And he gets in touch with me. Well, actually, it was his mother who got in touch with me, this incredible character who she was not going to let the company do that to her son. And so she gets in touch and says, you need to talk to my son. Let him tell you what's happened. And when he finds out, he says, oh my God, Mum, what have you done? But he does the right thing. He talks to me. And more importantly, he hands over this trove of documents.
So opportunity is one side of the fraud triangle. The second side is motivation. Here's Glenn Unicum again.
In my career, I've seen all sorts of situations. I've seen people commit fraud to pay for their mother or father's medical costs. I've seen people commit fraud because they have a gambling problem.
The third side of the fraud triangle is rationalization.
Most people don't like to acknowledge that they've done something dishonest. Or if they have, they need to justify in their own mind why it had to happen. And I'm sure in HIH that would have loomed large because HIH had been built from the ground up by Ray Williams, and I'm sure anything that would put the existence of something that he'd spent his whole life building under threat would be a very good incentive for him to rationalise the window dressing of the accounts.
Now, remember that poodle from the start of this episode? The one that was getting a haircut in a fisherman's house in the Philippines? For Dan McCrum, that poodle was the smoking gun. The final piece of evidence he needed to prove that all wasn't as it seemed with Wirecard. McCrum and his colleague Stefania Palmer had been investigating Wirecard's international payment partners. One of them was based in Manila, and when the investigators arrived at the address in question, they quickly discovered they weren't a payment partner at all. Poodles aside, there are many other telltale signs of accounting fraud. High on Glenn Unicum's list of fraud red flags is a presence of a dominant CEO.
Often the power from the CEOs, apart from their personality, arose because they had substantial shareholding in the companies. That is one of the most powerful indicators, a dominant CEO. Sometimes it could be just as much a dominant chairman.
Another factor to watch is a recent change of CFO.
Corporate accountants, in my experience, seem to have a conscience. So when they see that the company is not travelling as well as it should or as well as it's represented in the marketplace, they will get to a point where they will leave.
Jeffrey Luckens is another CPA adept at spotting corporate fraud. One of his favourite red flags to look out for is when cash flow from operations is much lower than operating income. Another is when rapidly growing revenue isn't matched by a boost in cash flow. And then there's the vibe.
The vibe is so important and you can't teach it necessarily. As an audit partner, I view culture, communications with the board and management, and their implementation of accounting policies as the first line of consideration as to whether fraud or error may be a key concern for the engagement. You generally get a vibe with that, and you may, for instance, focus more time on issues like revenue recognition, capitalisation of expenses, the global and or complex group operations.
When the dodgy dealings at Wirecard were exposed, questions were raised about why they were not detected earlier. Luckins agrees that procedural and sceptical scrutiny has an important role to play in detecting fraud. But he says there's often an expectation gap when it comes to audit.
It's a worldwide problem, and it hurts the auditing profession because every time that there's a high-profile company failure, stakeholders, including shareholders, media, customers, unions and employees, politicians, they want to blame someone. And they ask, how could the auditor have not realised that there was a going concern problem or a major fraud, mismanagement, things like that, given our privileged access to all the information of the company? For instance, in the recent case of Wirecard and the missing 1.9 billion euros in cash, which was, according to the company, with banks in Singapore, which they themselves then deny having any relationships with Wirecard, you can understand why prima facie stakeholders are angry.
To help close the expectations gap and improve outcomes, diversity is key.
Audit business is really no different to any other business in that having dependence on key customers, on key suppliers, on key financiers is never a good thing. So it would strongly encourage audit firms in particular to, have a really good selection of clients around a number of different industries. And for instance, with work that needs to be done at different times of the year, when you end up with that sort of a mix, then you don't become reliant on any one particular client. And when you also have that greater vision, we talk about protecting the ship. And protecting the ship means making sure that our audit firm is protected, that all of our people will continue to have jobs, that we'll be able to produce the work as we say we will, to be true to our own vision and principles, to have the sort of audit firm that we want to have, right? And if you end up having clients which are disruptive to all of that, that is not worth it. That is very bad for your own vibe.
Paying attention to perceived or actual conflicts of interest is also important.
I am constantly astounded by how frequently people do not understand the importance of independence and potential conflicts of interest. Whether in business, government and politics, not-for-profit organisations and the like, we are consistently seeing bad decisions made to satisfy someone's conflict of interest, which is not declared, recognised and or allowed to prevail.
The fallout of Wirecard's collapse in 2020 has been dramatic, including arrests, prosecutions and a full parliamentary inquiry. The scandal also resulted in the resignations of the head of Germany's financial regulator and the country's top accounting watchdog, the Financial Reporting Enforcement Panel. When Dan McCrum got the opportunity to interview Wirecard's disgraced CEO, Markus Braun, in 2014, he asked him bluntly, "Are you a crook?"
I found his answer really fascinating because he answered with a question. Classic way liars lie. Why would I do these things? And he did another thing. He used social proof. But what always stays with me is tone. I'm just very matter of fact about it. Whereas I think most people normally, if you ask them outright if they're a crook, well, they get a bit angry, and Marcus just didn't.
If you enjoyed this special Crime by Numbers episode, subscribe to the In the Black podcast, leave us a review, and tell your colleagues and friends about us. To find out more about our other podcasts, check out the show notes for this episode, and we hope you can join us again next time for another episode of In the Black.